Welcome to the Explainer. Look, if you've ever stared at a price chart and felt like the market was just randomly moving specifically to hunt your stop loss, you are absolutely not alone. Today, we are going to completely demystify market structure. We're looking at real chart mechanics, and we're specifically focusing on how to trade high-probability continuations in heavy momentum assets like Bitcoin and gold.
It's kind of painful to think about, isn't it? I mean, from an outside perspective, trading seems incredibly simple. It's a binary choice. The market can basically either go up or it can go down. So mathematically, if it's essentially a coin flip, why do 95% of traders consistently fail? Well, the answer lies in a massive psychological and structural trap that most people don't even realize they're walking right into. Here's the illusion. We're told the trend is your friend, so you just buy green and sell red, right? But the harsh reality is that the market actually spends about 70 to 80% of its time in consolidation. It's just moving sideways in ranges, channels, or flags. If you're blindly buying every minor push in a sideways market, you're going to get chopped to pieces and completely drain your capital. Our very first job as a trader is never to simply find a trade, but to actually understand the market's current phase. So here is our roadmap for today. 1. Market structure phases. 2. Candlestick control. 3. The continuation blueprint. 4. Execution and tactics. 5. Navigating liquidity traps. And 6. Risk management. All right, Section 1. Market structure phases. Understanding the environment before taking a trade. Before you even think about looking for an entry trigger, you absolutely must understand the environment you're stepping into. The market really only does 4 things. It trends up, it trends down, it ranges, or it reverses. That is it. In an uptrend, we see progressive higher highs and higher closes, so we follow the buyers. In a downtrend, it's lower lows and lower closes. We follow the sellers. But in a range, we see overlapping candles, wicks on both sides, and no real clear progress. Neither buyers nor sellers are in control, so we just avoid it. Most account blowups happen right here, when traders try to predict a direction inside a sideways market. If you're looking at Bitcoin or gold on a 4-hour chart, identifying whether you're in progressive higher highs or just overlapping chop is literally the difference between a massive win and an immediate stop out. And once we've identified that macro phase, we need to scale down to our trading timeframe and read the micro action. Moving on to Section 2, Candlestick Control, reading the battle between buyers and sellers. Okay, this is a massive concept to internalize. The market always needs to breathe. A trend just doesn't move in a straight, uninterrupted line. After a strong run, price has to pull back, and it will usually do so into dynamic levels of value, things like your EMAs or VWAP. This pullback is exactly what allows the new direction to continue clearly. It's an outside return, so when you see the price dipping against your main trend, don't panic. It's not necessarily a reversal. It's just the market taking a breath before the next big impulse move. Inside those breaths, we're reading control candle by candle. You aren't guessing the future here. You're observing objective pressure. If a candle closes bullish, buyers won that specific period. But what we really want to see is follow-through. We're talking about an engulfing candle or a strong rejection wick bouncing right off an EMA. Back-to-back bullish candles prove that buying pressure is actually continuing, not just hesitating. It's this consecutive structural confirmation that takes the guesswork completely out of the equation. Now, to trade these continuations safely, we need a tool to protect us from random wicks. Enter the ATR, or average true range. This is a technical indicator that measures the specific volatility of an asset. Especially when you're trading highly volatile assets like gold or Bitcoin, your stop loss must be placed safely outside the market's natural noise. If the asset averages, say, 30 pips of movement a day, you definitely don't want your stop loss sitting right at 15 pips, where it's just going to get clipped by standard everyday volatility. Section 3, the continuation blueprint, the step-by-step setup for entering the trend. Now, what's really interesting here is the actual mechanical sequence to catch the trend. Step 1, identify the strong run. This is your higher time frame trend confirmation. Step 2 requires patience. You wait for the market to breathe, for that pullback into what we call the kill zone or value area. You never, ever chase the impulse. Step 3, once you're in the kill zone, look for confirmation. If you're buying, you want a candle to form a higher high and a higher close than the previous candle. Step 4, enter the market with your stop loss safely tucked beyond the structure, plus that ATR buffer we just talked about. And always plan to take partial profits at key extensions to secure your capital. Remember, getting the direction right isn't enough. Timing the trigger is where the profit is actually made. Section 4, execution and tactics. Fine-tuning your entry for maximum profitability. So you generally have 2 ways to pull the trigger. The aggressive entry means setting a limit order and buying immediately the very second price touches your kill zone. Sure, you'll catch more trades this way, but your win rate is going to be lower because the market hasn't actually proven it's ready to turn yet. The conservative entry means waiting for that higher high, higher close candle. It absolutely demands patience. You won't catch every single setup, but your win rate will be significantly higher. Over time, your goal isn't just to take the most trades. It's to be right more often and capture more profit without the FOMO. But sometimes the market breathes a little deeper than expected, and that sets up what we call the last chance entry. If price pushes really deep to the very bottom of the pullback, the trend momentum is technically weakening, so you have to scale down to a lower time frame, like a 15-minute chart, and wait for a structural confirmation, like a double bottom, before entering. If Bitcoin flashes a deep retracement, wait for that 15-minute double bottom. Because your stop is incredibly tight here, it offers a massive 4-to-1 or even 5-to-1 reward to risk ratio. Just a couple of these can completely supercharge a portfolio. But of course, knowing the setup isn't enough if you don't know the traps. Institutional players need liquidity to execute large orders, and retail traders are usually the ones providing it.
Section 5. Navigating liquidity traps. How to avoid becoming the market's liquidity.
To survive in this game, you absolutely must understand inducement. An inducement is a false market move engineered specifically to trap impatient retail traders into entering too early. By getting you to buy or sell at exactly the wrong time, the market triggers a cluster of stop losses. And that pool of stop losses, that provides the exact liquidity required for the real institutional move to actually take off. We see this play out constantly through the Asia range framework. During the Asian trading session, volume is typically lower, which creates a consolidating range. You can imagine it like a blue box on your chart. The top and bottom of this box, the Asia high and low, become massive liquidity pools because traders just leave their stops there. When the Frankfurt and London sessions open, price will very often manipulate one side, induce retail traders to enter early, and then aggressively snap back in a continuation move to sweep the liquidity on the exact opposite side.
And this brings us to a specific trap you are going to see repeatedly, the break, test, continuation trap. Here's exactly how it works. A resistance level is broken. Great. Price then pulls back to test that old resistance as new support. Textbook trading, right? Well, impatient traders rush in to buy the test. But then the market dips just slightly below that support, sweeping their stops and inducing them completely out of the trade. Only after this inducement does the real continuation move finally launch. If you wait to see the inducement happen first, you get to enter with the smart money instead of acting as their liquidity. But listen, reading structure and avoiding traps means absolutely nothing if a single bad trade wipes out your account.
Section 6. Risk management. Protecting capital and maintaining psychological control. This right here is your golden rule. A 1-to-1 reward to risk ratio is the absolute bare minimum mathematical threshold to even consider taking a setup. If your target structure, say the recent high, doesn't offer at least the exact same amount of profit as the risk you are taking on your stop loss, you simply do not take the trade. If it's a 0.9-to-1 ratio, you pass. Secure partial profits at that 1-to-1 mark and let the rest run, ensuring the math is always, always in your favor. Ultimately, professional trading is kind of boring. And honestly, that's exactly what you want. Over time, your job as a trader is to take fewer trades, be right more often, and completely avoid the noise of those choppy sideways markets. You wait for the trend, you wait for the pullback into the kill zone, you wait for the confirmation, and you just let the structure do the heavy lifting for you. You never force it. Which brings us to a bit of a psychological reality check. Because knowing this blueprint is one thing, but mastering your own mind is a completely different game. So I want you to really think about this. Do you struggle more with FOMO, entering trends way too early and getting swept up in an inducement? Or do you struggle with analysis paralysis, waiting so long that you end up missing the pullback completely? Identifying your own personal weakness is step 1. Using the mechanical rules we just discussed is step 2. That wraps up today's explainer on trend continuations. Until next time, stay patient and trust the structure.